In this section, we will explore how the Federal Reserve's innovation policy contributed to the collapse of Silicon Valley Bank. The Federal Reserve, or the Fed, is the central bank of the United States and has a dual mandate of promoting maximum employment and stable prices. The Fed also has a role in fostering financial stability and supporting the development of the payment system. The Fed's innovation policy is based on a three-pronged approach: to engage, to collaborate, and to respond. The Fed engages with various stakeholders, such as banks, fintechs, regulators, and consumers, to understand their perspectives and needs. The Fed collaborates with other agencies and central banks to coordinate policy and share best practices. The Fed responds to emerging trends and risks by adapting its supervision, regulation, and services. One of the key areas of innovation that the Fed has been focusing on is the digitalization of payments and currency. The Fed has been exploring the potential benefits and challenges of central bank digital currencies, CBDCs, which are digital forms of sovereign money issued by the central bank. The Fed has also been developing a new payment service called FedNow, which will enable instant payments for all Americans. However, not everyone is happy with the Fed's innovation policy. Some critics argue that the Fed is too slow and cautious in embracing new technologies and business models. They claim that the Fed's regulatory approach stifles innovation and competition in the financial sector. They also accuse the Fed of being biased towards large banks and incumbents, while neglecting the needs of smaller banks and fintechs. One of the victims of this alleged bias was Silicon Valley Bank, SVB, a regional bank that specialized in serving technology companies and startups. SVB was one of the pioneers of fintech partnerships, offering various products and services through collaborations with fintech firms. SVB also invested heavily in innovation and research, supporting initiatives such as blockchain, artificial intelligence, and biotechnology. However, SVB faced several challenges from the Fed's innovation policy. First, SVB was subject to stricter supervision and regulation than its fintech partners, creating an uneven playing field. Second, SVB was excluded from participating in some of the Fed's innovation initiatives, such as FedNow pilot program. Third, SVB was unable to compete with large banks that had more resources and influence over the Fed's policy decisions. These challenges eventually led to SVB's downfall. As more customers switched to faster and cheaper payment options offered by fintechs and large banks, SVB lost its competitive edge and market share. As SVB's profitability declined, it became vulnerable to liquidity and solvency risks. In 2023, SVB failed to meet its capital requirements and was forced to close down. In conclusion, we have seen how the Federal Reserve's innovation policy fostered the collapse of Silicon Valley Bank. While the Fed's policy aimed to support responsible innovation and financial stability, it also had unintended consequences for some players in the financial sector. The case of SVB illustrates the need for a more balanced and inclusive innovation policy that considers the interests and needs of all stakeholders. Silicon Valley Bank was a major player in the tech industry, providing banking services to nearly half of all U.S. venture-backed technology and life science companies. It had assets of about $209 billion in December 2022, making it the 16th largest bank in the United States. But in March 2023, it collapsed in a matter of days, marking the biggest U.S. bank failure since the global financial crisis. How did this happen? The collapse of Silicon Valley Bank was the result of several factors, including its risky investments, its dependence on deposits, its exposure to fraud, and its failure to raise capital. Let's look at each of these factors in more detail. First, Silicon Valley Bank had invested heavily in startups and venture-backed firms, hoping to profit from their growth and innovation. However, many of these investments turned out to be unprofitable or even fraudulent, leading to huge losses for the bank. For example, the bank had lent $1.5 billion to Theranos, a blood testing company that was later exposed as a massive fraud. The bank also suffered losses from its investments in WeWork, Uber, and other tech unicorns that failed to live up to their hype. Second, Silicon Valley Bank relied heavily on deposits as its main source of funding. Unlike other banks that have access to cheaper and more stable sources of funding, such as bonds or interbank loans, Silicon Valley Bank depended on attracting and retaining depositors who were willing to park their money with the bank. However, this strategy backfired when depositors started to lose confidence in the bank's solvency and withdrew their money en masse. This triggered a bank run that drained the bank's liquidity and made it unable to meet its obligations. Third, Silicon Valley Bank was vulnerable to fraud and cyber attacks that compromised its security and reputation. In February 2023, the bank disclosed that it had been hacked by a group of hackers who stole $100 million from its accounts. The hackers also leaked sensitive information about the bank's clients and employees, exposing them to identity theft and blackmail. The hack was a major blow to the bank's credibility and trustworthiness, and prompted many customers to close their accounts or sue the bank for damages. Fourth, Silicon Valley Bank failed to raise enough capital to shore up its balance sheet and restore confidence in its viability. Capital is the cushion that banks use to absorb losses and protect depositors. The more capital a bank has, the more resilient it is to shocks and crises. However, Silicon Valley Bank had a very low capital ratio compared to other banks, meaning that it had little room for error. When the bank tried to raise more capital by selling shares or assets, it faced resistance from investors who were skeptical about its prospects and demanded high returns. These factors combined to create a perfect storm that brought down Silicon Valley Bank in March 2023. The California Department of Financial Protection and Innovation closed down the bank and put it under the control of the Federal Deposit Insurance Corporation, FDIC, which guarantees customer deposits up to $250,000. The FDIC then sold most of the bank's deposits and loans to First Citizens Bank, a regional bank based in North Carolina. The FDIC also announced that it would make all depositors whole, even for those funds that weren't protected by its insurance limit. The collapse of Silicon Valley Bank was a shock to the tech industry and the financial system. It raised questions about the soundness of other banks that were exposed to similar risks and challenges. It also sparked a debate about the role of innovation and regulation in banking. How can banks balance innovation and risk-taking with safety and soundness? How can regulators foster responsible innovation while preventing systemic failures? These are some of the questions that will shape the future of banking in the aftermath of Silicon Valley Bank's collapse.